You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. Over the last few years, the labor market has survived aggressive Fed tightening, a regional banking crisis, and relentless consumer pessimism. Rates for hiring and layoffs have been low, but the unemployment rate has steadied near 4.1%, and job growth has kept chugging along. The labor market's next big test will be how it adjusts to changing policies pertaining to immigration, tariffs, government layoffs, and government spending cuts. On today's episode, we talk with Guy Berger, Director of Economic Research at the Burning Glass Institute, about the risks from a low-churn labor market, how employers are responding to federal policy changes, and how the labor market could respond to coming policy shocks. Stay tuned. Coming up soon, our interview with Guy Berger, but first, a quick market update. President Trump's additional tariffs went into effect at midnight April 9th, only to be partially paused later that day. Tariffs over 100% are still in effect on imports from China, but most countries will see their exports tariffed at 10% for the next 90 days to give political leaders time to negotiate. The erratic policy changes spurred an unusual combination of U.S. stock market declines, a Treasury market sell-off, and material dollar weakening last week. Bloomberg's benchmark Treasury index suffered its worst weekly loss in almost 25 years. There are a few potential explanations for last week's big moves, though nothing is conclusive just yet. The unusual decoupling of the dollar and 10-year Treasury yields suggests foreign investors may have unloaded some American assets as the U.S. market became marginally less attractive as a safe haven. Treasury Secretary Scott Bessent said, however, foreign investors were active participants in last week's coupon Treasury auctions. Hedge funds in particular may have exacerbated market moves by extensive deleveraging, but the magnitude of their impact is unclear. Chair Powell called the big financial market swings volatile but functional in an appearance earlier this week, throwing cold water on the idea the Fed might feel compelled to step in to prevent any systemic instability. Somehow, only barely in the list of top 5 things to happen in the last 2 weeks, the March core CPI grew at its slowest pace since January 2021. Overall first quarter inflation nonetheless made very little progress from the fourth quarter, and traders have mostly dismissed March data as stale since it captured economic activity before the momentous April 2nd tariff press conference. Retail spending rebounded in March, growing 1.4% headline and 0.4% in the control group series that feeds directly into GDP estimates. After the release, the Atlanta Fed's GDP Now model estimates negative 0.1% first quarter growth when adjusting for gold imports. There will be a few more data inputs before the official advance release of Q1 GDP comes out on April 30th. That's all for the market update this time. Now our interview with Guy Berger. Our guest today is Guy Berger, Director of Economic Research at the Burning Glass Institute. Guy, thanks for coming on the podcast.
Glad to be here.
Our topic today is the 2025 labor market, how it fared in the first quarter and how it could respond to various federal policy shocks throughout this year and onward. Now, we're recording today in the shadows of President Trump's April 2nd tariff announcement, but I think it's important to understand how the labor market was doing beforehand to get an idea of how well it can withstand any of these upcoming policy shocks. So, Guy, we got the March employment report last Friday. Job growth was solid, but January and February were revised lower. The unemployment rate held pretty steady again, but I get the sense that no one is really sure whether the labor market is really resilient or on the precipice of a downturn. How would you characterize the Q1 labor market?
The way I would characterize it is, I think, okay, or maybe shaded upwards a little bit to decent. I think there's a lot of folks that sort of say this is a great labor market, et cetera. And I don't think that's really, in my opinion, been true for at least a year, maybe a little more than that. You know, I think it depends where you are. If you've had a job, you've been pretty secure because layoffs have been very low, but hiring has also been low. So people that don't have a job that need one have genuinely been struggling. But it's definitely not bad by any means. I think if we got jobs reports like the one we just got, just in perpetuity, then I think we'd be pretty happy. I think the odds of that happening have diminished. We're already, I think, diminishing before the April 2nd announcement. And after that, I think they're going to diminish by more than I thought they were going to. So I'm a little worried or more than a little worried, to be honest.
Yeah, I think what really complicates my ability to understand those underlying trends is if you look back over the last 9 or so months, you have a lot of volatility month to month with job growth, and you can say October was an outlier because of these hurricanes, and then January was an outlier because of these storms or the wildfires, and it's hard to know then what the smooth trend is, and so I think it can go either way, and that's what adds to the confusion. Now, even though the unemployment rate has been steady for quite a while, rates for hiring and quits are incredibly low. And I think this is an interesting contrast to a couple of years ago when workers were leaving jobs and getting hired so quickly that companies were in what looked to be a frenzied bidding war for labor. And at the time, Fed Chair Jerome Powell even called the labor market unhealthily tight. Do you think the low level of churn today is concerning? Will it make it difficult to absorb any coming policy shocks? Or is that level of churn today just a sign that the labor market is in pretty healthy balance?
I think the first part is some of this is maybe normal and reflective of an older population. As a population ages, most of us, we hop around a lot early in our careers, we get sold in, job tenure starts to get longer. And I think some of that, if you compare it to history, to what hiring and quits rates were in like 20 years ago, I think there's some of that. So that's the first thing to think about. Then there's a second part, which is I think beyond that, I think these are unusually low given the state of the labor market. And intrinsically, even if, as I think it is, theoretically, is something that could be stable for a while with no interruptions if we had now all these new policy changes, I don't think that's great because I think, again, it's miserable for people that are trying to find a job. They're struggling the same way that people were struggling in 2013, 2014. Not the worst part of that expansion, 2013, 2014 was certainly better than 2009, 2010, but it's not great. And I honestly, I've kind of disagreed with some people. I think this could go on for a while, again, without interruption, if there wasn't other things. And the last part is, well, what happens if all of a sudden we have this big negative shock that hits the labor market? Is the job market set up to absorb a lot of people? I don't think so. I think that in all likelihood, hiring will go down even more. So it'll get harder to find a job. We will probably have a bigger pool of, the people that are experiencing this distress. I mean, a blessing is that unemployment's still low. So yes, it sucks to be unemployed looking for a job, but there aren't that many people. What if all of a sudden that pool of people grows by 25, 50, 100% during a downturn? That's a lot more misery. And then on top of that, layoffs have gone up a little bit over the past few years from the best part of that super hot labor, in Jerome Powell's words, the unhealthily strong labor market of 2022, but they're still quite low by historical standards. What if layoffs go up by 20, 30, 40%? I think this could be something that turns from a unpleasant situation for a small group of people to a very difficult situation that affects a lot of them.
And I think that's a really great way to put it because we need the labor market, we need the economy to be dynamic, and of course policy changes are always going to happen. That's a part of our democratic process. But within that context, certain shocks can be too hard for the economy to adjust to. I mean, just look at the pandemic. That was one big shock during a short period, and the economy took a long time to adjust to it. Now, I want to shift a little bit to just the idea of policy expectations. I know we're almost 3 months into this second Trump term, but there's a lot that's still in limbo. Maybe things will be overturned by the courts. Maybe Congress needs to reinforce some executive branch decisions. So just based on policy expectations, have you seen any sorts of evidence that private sector industries are shifting their hiring plans just based on policy expectations? Maybe it's the sectors that are sensitive to federal spending cuts, sensitive to tariffs, or companies that hire a lot of foreign workers.
Yeah, we have seen it. And I think what's interesting is there's this thing that suddenly has become a little trendy, which is saying that the president has been saying he was going to do this forever. Why is anybody surprised? We can debate why people are surprised, but people have been genuinely surprised. The Census Bureau conducts a biweekly survey of U.S. companies in the private sector. Right after the election, these firms, rightly or wrongly, became more optimistic about their hiring plans. And this persisted for several months. even into the beginning of the term, and then started eroding in February, even before the April 2nd tariffs. And I suspect, I mean, we will see, we'll get data that includes some of that post-April 2nd period this week, but they become more pessimistic. This even includes manufacturing, which was one of the sectors that most intended to support, boost employment, but manufacturing firms are suddenly telling us we're cutting back on our hiring plans. And so, yeah, there's been a real chill. Now, there's two parts of this I think get thrown out. One is uncertainty, which is that, yeah, I don't know what policies are going to get implemented. That is still there. It's substantial and higher than normal. We have, measures there's a very common one that comes out by Bloom and Baker that tracks uncertainty in the news and particularly uncertainty surrounding trade, and that's off the charts right now. But I don't think it's just about uncertainty. It's not like if we resolve the uncertainty, I mean, yes, that helps somewhat. It's better to have no uncertainty than a lot of uncertainty. But some of it's the policies themselves are ones that companies don't like. If I resolve uncertainty by putting huge tariffs that disrupt my supply chain or going to cause retaliation and make it hard for me to sell things overseas, that hurts my business independently of any uncertainty. And so I think that the mood has definitely soured. I expect it's soured relative to the latest data we have as of March. It's going to be a challenging environment if these policies go into effect on, I guess, on the 9th, I think is the date that all these are supposed to kick in. At that point, it becomes reality, not just a scary thing.
And I think on top of that, there is this, going along with the idea that people are surprised of this follow through on certain policies. There's also a lingering assumption that they could be potentially taken back if the financial markets do bad enough, if the economy goes badly enough, and that does create a little bit more uncertainty. But I want to key into specifically companies that are looking at H-1B, which are sometimes called skilled visas. Are you seeing companies that have just decided, you know what, I'm not going to try to hire for jobs that are open to those types of workers because there's just the potential that, we won't be able to get an H-1B visa for this new hire, and we've just shifted entirely to looking at people with U.S. citizenship?
This is the kind of thing that happens once you are in this kind of environment. And if, as I think a lot of people expect, the visa regime is going to become more restrictive, it is going to be harder to access that kind of labor, you're going to consider alternates. In some cases, by the way, what this paradoxically moves employment moves overseas, because if you can't bring the people over here, put an office somewhere else and just shift more activity there. In some cases, I think there is going to be the conclusion, we're going to hire more aggressively domestically. That affects things in a different way because this potentially squeezes companies' bottom lines. And so it might be that you're like, well, I'm going to pay more to hire domestically. Other staff that I'm hiring, I might have to cut back on them because I have less budget to do that. Or I might have to raise prices on the things I produce. So it's not, the point is, it's a cheesy thing to say, but the economy is a very complex system. The phrase, there's no such thing as a free lunch, has some nuance around it, but it is the thing where if you move some of these things and they generate some outcomes you like, and simultaneously going to generate other outcomes that you don't really like, and there's a good chance to imagine that those outcomes you don't like, those secondary outcomes, are not really under consideration right now, but will emerge once these policy changes are implemented. So you restrict H-1B visas, that's going to potentially, in some cases, if they don't move offices overseas, increase better outcomes for labor that competes with those folks. But it may have other results, like making software, certain kinds of high-tech outputs more expensive, cutting back on other kinds of employment. It's a complicated system that we're taking big swings at and trying to push in a certain direction.
Now, the argument behind a lot of the federal job cuts that we've seen, it's not only to trim, the government budget, but also there's this motivation that, well, if you reallocate labor to the more efficient private sector, the economy is better off, and there's a kind of better equilibrium of wages and employment and demand for certain skills. Now, I think that could be correct in some sort of big picture, long-term equilibrium, but if the pandemic showed us anything, it's that sometimes the demand mismatch is quite significant. So, in early pandemic shutdowns, you had a lot of restaurant workers or theater workers in Midtown Manhattan that weren't suddenly needed there. And people had moved to the suburbs, and now they needed people to work at restaurants closer to where they were living. In any case, the point is there's not always a smooth adjustment process for those laid off workers to find new work. So, the federal job cuts that we've seen so far, assuming they're not reversed, do you think these people generally have skills or are in geographic locations that have a good chance of being quickly absorbed into the private sector? Or are a lot of them, I don't know, academic researchers and park service rangers where there's not necessarily private sector demand for them?
I love your example of the pandemic. I think it is a good analog because part of it is there's a good chance we're going to be experiencing a recession, or at the very least a cutback in demand, which itself is slows and sort of throws sand into the gears of this adjustment process. I don't think it's binary. People do adjust. You give it time, and those people move doing other things. Like, that happens. And it's unpleasant, by the way. I don't mean to suggest this is necessarily a good policy or that it's good or enjoyable for the people, but like, this happens. It's probably better if you're going to undergo this big change to do it very gradually, to improve make it as frictionless as possible. And simultaneously, the other aspect is, and let's think about the pandemic. I think it's like, actually, there's another aspect of it. The economy reopened. A lot of those sectors that shed a lot of workers suddenly had a lot of trouble getting those workers back. I think that if you really think about some of these activities, like fundamental R&D or certain kinds of aspects of skilled work in the government, when those workers are let go and they do end up finding out if things are moving, at some point, I suspect we're already finding it, that sometimes the government lays people off and they say, air traffic controllers, can you please come back? That starts being hard because, the change, once it happens, just like it's hard to induce, it's hard to reverse. And there's going to be that cost that we're not accounting for right now that I suspect, again, my feeling is a lot of these changes eventually will be viewed as regrettable. They're costly to undo. And so I guess some people will consider that a feature, not a bug. But to me, I mostly think of it as a bug. And I'm pretty worried about that aspect too, as well as the short run adjustment cost, which is quite high if the large magnitudes being suggested are actually accurate.
The surge in migration the last few years, I think, was a big contributing factor for how the economy recovered without giving much of an inflationary impulse. Now, if we have stricter immigration enforcement, that does mean lower labor force growth. So is there a weird mechanism where the labor market might actually look tighter, the unemployment rate will go down, and we could see a rebound in churn? Or what's your kind of baseline expectation for how the labor market will adjust to border enforcement being a lot stricter than it was a few years ago?
Let's set aside the possibility that we're going to see, because I think it's been thrown around, but like mass deportations. We will see how much of that happens, but let's set that possibility aside. Fewer people coming in through the border. Also, what if we talked about H-1Bs. What if they cut back on visas? There was a big surge in visa issuance during the prior administration. A lot of leeway for the current administration to cut. I mean, I don't know the exact thing, but they can reduce that flow at the very least by making the process slower. I think it's a good question if you think about it. And I think one of the things I've sort of tried to get people's mindset to think about is people are sort of used to all these economic indicators moving in the same direction. Strong employment growth, strong GDP growth, unemployment rate going down. I think that part of what we saw in a lot of 2024 is these things don't have to move in the same direction. GDP growth can be strong, employment growth can be strong, and the unemployment rate can go up at the same time when you have a big boost of supply. The reverse is true when labor supply is actually growing very slowly or shrinking, is you can have a labor market that tightens even as you're adding very few jobs and economic growth is slow. Is this a good thing or a bad thing? I think depends on your perspective. And I can actually kind of understand why people have complex feelings about it. There's one of the reasons why there's some controversy here is some people are like, well, I want a tight labor market as much, above all else, and therefore this is a good policy. I think it can be debated because I think there are other costs. Maybe these workers that's the side labor market, but the average jobs are worse because of that. But I do think that it is possible that right now we're focused on the tariffs, but later on the labor force supply restrictions become more salient. At that point, we start seeing an environment where some people are like, "Wow, growth is really slowing down." and it's a reflection of lower rates of labor supply growth at the same time as the labor market's tightening, and the unemployment rate is flat or coming down.
Now, another argument, one of the many arguments that I think proponents of stricter immigration enforcement like to put forth is that it frees up more opportunities for U.S. born workers. And so a lot of, the thinking goes that a lot of these people coming into the country might displace U.S. born workers, and those people maybe stay on the sidelines. But I'm curious, even under that argument, how much slack do you think there is in the U.S. born population right now to absorb a fall in the labor force, in the labor supply, I'm sorry, because, the employment to population ratio for people who are prime age, they're 25 to 54. It's meant to exclude those people who might be on the verge of retirement or still in higher education. That ratio is close to its highest in, I believe, 25 years, which would suggest there aren't many idle potential workers around to pick up that slack. On the other hand, I believe that metric doesn't measure native-born versus U.S.-born workers. So what do you think about that issue?
I would never say never. If all of a sudden, like we shrink the labor force, then employers will do their best as much as it makes sense for business to substitute for it in various ways. Some of it's technology, some of it's trying to bring retirees or college students or high school students. I mean, we even see some states essentially lowering restrictions on teenagers working to alleviate what they view as labor shortages. So I think the point is the system tries to adjust in all sorts of ways. It is that the argument that it's not possible for more people to work, like that's just not true. I think that there are other outcomes, though, that are not great. I mean, if you think about, I'll give the example of teenage labor. I mean, these are people potentially foregoing education and lowering their long-run human capital and career prospects in some cases because they're spending less time learning and more time working. I think that there are trade-offs here. It's going to make goods and services more expensive. In some cases, it is going to lead to certain goods and services no longer being produced here because it's too expensive to make it here. In some cases, there's going to be automation. So, there are all sorts of things that can happen here. I think it will result in employers reaching out to certain talent pools that they don't typically, reach out to. And we saw that, by the way, in the pandemic is, once the economy started opening up, because initially labor supply, foreign-born, was less available, is we saw teenagers actually very active in the workforce. And I'm just throwing out there that the system adapts in various ways. But what we also saw is one of the ways the system adapts is prices going up, and people don't like that. So this idea that this is some sort of free lunch, I don't think so. And I think in a lot of ways it can lead to a labor market, even if the unemployment rate's not higher, that people consider to be worse.
And I think that's right. Again, using the pandemic as a historical lesson, of course, I don't think any of the federal policy shocks this year will really equate to the pandemic entirely, but certain industries were more feverish in that labor scarcity than others. And so, sectors like agriculture or construction that do hire a higher share of foreign-born workers, they could really be at a loss during that adjustment period, and maybe prices for food or building more housing, which I know is a big cost of living issue right now. Those things will go up, and we might not be able to find native-born workers to fill in for that slack right away.
Yeah, it takes time, and I think that's sort of it. Keep coming back to that example of reallocating the workers. The system adjusts. One of the ways people shift sectors, people move from sectors where labor, and they might have to move locations too, which adds another layer of cost. The system will eventually adjust, but that adjustment's painful. And where you at, one thing that I guess I also like to emphasize is there's sort of thing of a lot of people are like, well, there's some short-term pain, but the system will adjust. A lot of times the adjustment that's on the other side is inferior to the starting point. And I think that part is underrated. Even once you adjust, there might still be costs relative to what you would have otherwise been. So it's one of those cases where it could be that, eventually all those former government, I mean, I don't really mean this, but all those former government workers go and work in making T-shirts. They move from DC and they go and make T-shirts in, somewhere in the Midwest. Is that, after that adjustment, is that a good adjustment? I think a lot of people wouldn't consider that to be a good adjustment. And I think that's a key part of it, is that just because there's you adjust does not mean that your other outcome is a better one. It could be quite worse than the status quo.
I think another big question that macroeconomists and people who watch financial markets have really tried to wrestle with over the last few years is why pessimism has been so intense while the traditional economic indicators that economists look at, like unemployment and inflation, are quite good. So there have been some explanations about, well, yeah, people are frustrated about price levels rather than price changes. Inflation is a change of price rather than the price levels. Maybe it's political polarization, all these different ideas. But specifically when it comes to the labor market, I do see in surveys that people tend to be pessimistic about their ability to make higher wages, maybe make a shift to a better job. Do you have any way to reconcile this? Does it go back to what we were talking about in the low churn labor market where, yeah, people are retained in jobs, but maybe they can't be very choosy with their opportunities and they're accepting lower pay than they want, they're underemployed. How do you kind of reconcile this pessimism with a 4.1% or 4.2% unemployment rate?
I'd say there's two parts of it. The first is that when we talk about sentiment surveys, I tend to put a lot more weight on what people think and more answers to more concrete questions relative to abstract concepts like the economy. So if you ask somebody, how's the economy? I mean, there's a stand one that people show that like people are grumpy about the economy but feel good about their personal finances that I think starting out. But like, so when I ask somebody, is it a good time or a hard time to find a job? And they answer it. I put some I kind of try when that gets worse. I think that sends a signal. When it gets better, it also sends a signal. Or when companies are telling me their hiring plans, I mean, they can change them. So it's not quite the same thing as what they're doing right now. But I do take it seriously. The way I would think about it is when people say, there's this is a legendary one of the things that economists follow. It's called the labor market differential from the Conference Board. Share people saying jobs are plentiful, less share people saying jobs are hard to get, and I think the fact that it's gotten worse very much reflects this weaker hiring environment. I mean, even if they're employed, people might still have an opinion from talking to people about what's out there. And they know that there's less stuff out there. Now, if they're in their job, then that's not the end. And there's low risk of layoff. That's not the end of the world. And if they're happy in their job, then it's actually not a problem at all because, you know what, they could just sit comfortably where they are. But I do think that that part is real. I think what part I have a little less confidence is taking seriously like how people if the economy is good or not. I mean, what's the economy? Just like we had this huge debate about what a recession is in 2022. And I think that people have these are abstract concepts that don't reflect what people experience in real life, or maybe have a vibe like vague interpretation of what's going on and how they feel about things. And people just in general seem to have gotten grumpier about the economy. A given state of the economy relative to what they felt in the past. That doesn't just reflect, cooling hiring or higher inflation. I mean, higher inflation may have caused the shift, but it's not just that.
It's true. When I would hear from people, non-economists, regular people in 2023 that the economy was in a recession, I'm pretty sure that most of them were not familiar with what the NBER was looking at to define a recession. Really what they were saying is, I don't like the economy right now, which probably meant I don't like high prices. I want to end with one question about your look into the crystal ball for the future. We're recording right now on April 8th, so it is before that potential deadline for additional tariffs to go into effect, and we only have the first quarter of labor market data. But as things stand right now, what is your estimate for the unemployment rate at the end of this year?
I think there's a good chance that we're going to be grazing 5% or above it by the end of the year. Again, it's not there are probably people that have more precise models than whatever. Like my feeling is we have this big shock that's hitting the economy. It's going to hit demand. It's going to hit supply. Companies are going to cut back on hiring further. And they're going to quite possibly increase the layoffs, and that's going to create a lot more unemployed people. I don't think this is going to be as bad as the Great Recession, much less COVID. It's going to be something that plays out over a matter of months, not weeks, as it did in March 2020. But I think this is going to be a worse labor market. I'd be pretty surprised if it isn't. And we haven't even talked about the impact of federal government layoffs. We don't know what the scale is ultimately going to be. But some of the numbers are thrown out as hundreds of thousands of workers. That's not nothing.
So a follow-up question to that, while I still have you here, if the unemployment rate were to go above 5%, it does seem like there would be a triggering of the Somme rule. Now, I think for good reasons. That didn't happen last year or 2023 to 2024. But if the unemployment rate were to go above 5% by the end of this year, does the labor market get into that negative feedback loop of more layoffs mean lower consumer spending, which means more layoffs and lower consumer spending, and we get on the path to a recession that usually means the unemployment rate goes up at least 2 percentage points?
I'm not gonna like hem and haw. Like what I'm describing is a recession, not a super long or severe one, but quite possibly one that looks like the one in 2001 did, where the unemployment rate went up. And then the question is, what happens afterwards, and what point we stabilize? At some point, things stabilize. The U.S. economy gets used to being an economy with high tariffs, and imposed by ourselves, and exporters somehow adjust to the higher tariffs that exist abroad, and that's an economy in the short run has a higher unemployment rate. So I don't think it keeps going on and on and on until forever. But yeah, I do think there's a good question about, Guy, you're sort of saying we're going to be grazing or above 5%. Is it really that you're talking about that by 2026 we're a little closer to 6% unemployment rate? I think it's definitely well within the realm of possibilities. But just thinking about that, I feel like we're going to be seeing worse labor market data by the summer. And I think there's going to be a period sometime starting the spring or summer into toward the end of the year that's going to look recessionary, where the unemployment rate's not going up by like a tenth every month or two, but going up by 2-3 tenths every month.
All right. Well, we'll have to see. But Guy Berger, thanks for coming on the podcast.
Thank you for having me.
That was Guy Berger, Director of Economic Research at the Burning Glass Institute. A lot of the current financial market commentary has understandably focused on whether the economy is going to tip into a recession from all the federal policy changes this year. And while that's certainly important, Guy brings up a great point about the need to consider what the labor market looks like after any inevitable adjustment process. Recession or not, it will be important to see whether workers end up in better or worse jobs than they had before these policy changes. That will have impacts on the U.S. economy much longer term than just this business cycle. Next week marks the last opportunity for Fed officials to speak before their pre-meeting communications blackout begins April 25th. A few FOMC participants are scheduled to make public appearances next week, but nothing yet including Chair Powell. Also next week, the Fed will release its latest Beige Book. The data calendar next week is relatively quiet, featuring the preliminary S&P PMIs and some housing market data. The following week is much busier, with the March JOLTS, April ADP, an advance release of Q1 GDP, and the ISM manufacturing. That week also ends with the May 2nd release of the April jobs report. Also that week, Treasury will announce its quarterly financing estimates on Monday the 28th, and then the profile of the Treasury issuance it expects to meet those financing needs on Wednesday, April 30th. There's a widespread expectation that coupon auctions will remain unchanged, but there may be guidance about larger issuance in the future, especially after private sector individuals on the Treasury Borrowing Advisory Committee publicly suggested it would be best to drop the current guidance, saying coupon auctions would remain unchanged for the next few quarters. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.